Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. This week I'm covering a few financial stocks, and I put a buy article out on a smaller bank that's in the S&P 500. I'm going to put an avoid article out on Wells Fargo, which is a larger bank. This video is going to be about PayPal, which isn't really a bank, but it is a financial stock. And it's going to be a sell recommendation or idea. And what those are businesses that are doing really great, or at least very good, but they've gotten expensive enough where if you own the stock, you should probably be thinking about taking profits, maybe putting a trailing stop on the stock. So we're going to get into the details here on some of the numbers with PayPal, why I think it's a good company, but it's just too expensive to probably keep holding here for very much longer. Before we do that, I'll take a look at some of the other sell ideas that I've had on the channel, and we'll see how they're doing so far over the past month or two. Now I just want to take a quick look at some of the other sell ideas I've had since we started the channel this year. Taking a look at, and we had a pretty big lift in the market this week, so that's helping some of these guys out. So let's take a look here. Estee Lauder in particular was, I think, down when we had checked it last week, but they had a good earnings report that everybody liked, and it had a giant pop. I probably expect this to pull back a little bit more. So still really expensive. Overall, these ideas are up a little bit, but they aren't up as much as the S&P 500. So they're still underperforming as a group. Apple's probably a good example of that. It's up about 3%, but over that same time period, the S&P 500 is up almost 5%. So you can see everything except for Estee Lauder is underperforming compared to the S&P 500, and they're trailing by a couple hundred basis points here. So that's how we're doing so far. It's going to take several months before we can kind of see some patterns develop here, but I want to get in the habit of checking in every week and just following up on how the previous suggestions are doing. Okay, I'm going to have a short disclaimer, and then we'll get right into the analysis of PayPal. Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. This is a really straightforward stock to analyze, and so there really isn't too many adjustments or things that we need to kind of think about here. The numbers are, like I said, pretty straightforward for investors, but I'm going to run through them and let you know kind of what I'm thinking here and why I think it's a pretty good time to start thinking about taking profits if you own this stock. First of all, let's look at the shaded green area on the fast graph here. These are adjusted EPS, earnings per share, since it was spun off from eBay back in 2015. And as you can see, this is just fabulous. Basically, this would be a secular growth company now that it's gone through a recession and still managed to grow earnings. These are the type of companies that you really want to own for the long term. So everything looks great with the business here. If you've been following the news around it and recent developments and so forth, they're all good basically. So nothing bad to say about the business at all. What comes into question here is this black line represents the price, and if you compare that to the slope of the dark green line, you'll see we have a huge jump in price. And while the earnings are still rising nicely and are expected to keep rising nicely, the price is gotten way ahead of those earnings. Okay, and so these are the times where we might want to think about taking profits, because it's likely this price will come down a little bit and eventually kind of meet this blue line at some point. So, or it could just level off, but the returns are probably not going to be great, especially over, say, like 5 years or so. When we first just examine kind of what this looks like. And I'll get into more of the numbers later, but we can see how it shapes up here. Generally, the fast graph earnings growth rate is about 24%, a little under 24%. It's expected to grow about that going forward, maybe slightly faster. Analysts are pretty optimistic about the business right now. So, but we're right in kind of that same range going forward. This last year, they only grew 14%. So it's not like they did awesome this last year, but we did have a recession. But one would think that as more things moved online, maybe they would do better than normal. So they probably had some sort of balance between those two in 2020, where earnings still grew but didn't grow as fast. They didn't grow 25%. Okay. Let's take a look at some of these other numbers here. Okay, so looking at my spreadsheet here, so these guys are a secular growth company. They're very rare. There's not very many true secular growth companies. There's going to be a little bit more this cycle because of the oddness of the COVID recession. Some companies were able to grow through it in a way they would not otherwise. But I consider secular growth companies ones where earnings always go up. Basically, there's no downturns, and that's what you see here with PayPal. Now, during a normal recession, will they be able to continue to do that? We don't know, but so far the evidence is in their favor, so that's how I treat them. The average PE since they've had their IPO is 32, and that seems like a pretty reasonable average PE to me for a company that's growing, in the above 20% per year. So that seems very reasonable for an average PE over that time. Now, the current PE, and I'm using, let me show you what earnings I'm using here. I am using 2021's earnings of $4.54 per share, okay, to calculate the current PE. So that's combined with the current price, is almost 60. So it's almost double its normal PE. And if the PE were to go from 60 to 32 over the course of 10 years, an investor would lose almost 6% per year for 10 years if it made that sort of adjustment. And the only thing that that determines this is just how people feel about the stock. So typically what happens with a stock like this when it gets really expensive is maybe earnings keep growing, but maybe they grow 10% or something in a couple years. Maybe it's not next year, maybe it's the year after that. People were expecting almost 30. Well, that's the type of thing that can send a PE from 60 down to 30 really fast for a company like this. And that's the sort of drop we're trying to avoid by taking profits when things are going really well, okay? So they haven't bought back a lot of shares, so that doesn't really come into play too much here. The fast graph estimate is almost the same as my estimate. Now, probably the only thing that's different, the reason that mine's slightly lower is because I just take into account slower years like this. This wasn't a down year, but it kind of depends on the stopping and starting point. I kind of average these out a little bit more, so these slower years will be taken into account rather than measuring from point to point. So but they're basically the same, about 23%. So now, if I was getting ready to buy this stock, I always limit my long-term growth expectation to 20%. So if I was going to buy it, I'd be more conservative, but since this is kind of a bearish video, I try to be as generous as possible. So we're going to assume they can keep growing earnings over 22% for 10 years each year, okay? Now, if you invest $100 if you just bought PayPal for $100 and you collected all of its earnings from the business for yourself for 10 years and they grew at 22% or almost 23%, you would end up turning your $100 into $161. Okay, that's what I use to calculate this business CAGR. And as you can see, you would earn money if you bought PayPal's whole business and grew it at over 20% and kept all the earnings for yourself. But you wouldn't earn a lot. I mean, you'd be earning almost 5% per year. Okay, once this gets under 5%, for me, that's when I start thinking about taking profits in a stock, if it's because the price is kept going up. Now, I combine that with the mean reversion, okay, to get my 10-year estimate. and this is negative right now. So it's entirely possible if PayPal had a couple slow growth years, you know, maybe if you go back and look at like a Microsoft history or something, you can kind of see this where they kept growing. Maybe I'll just do that. Let's just take a look. Let's look at Microsoft really quick, because I think it might be a good example, a good historical example of what could happen with PayPal. Now we can see Microsoft is doing great here, but if you go back here to these years, okay, so leading up to the 2000, they were growing earnings really fast, you know, like 20, 30, 40%. And then they kept growing earnings during this time, 6%, 2%, 13, even 20 here. But if you bought the stock here and you held it for 4 years, you would have lost like 8% a year. So that type of dynamic, that's what could happen with PayPal. So that's what we're trying to avoid. Again, Microsoft still growing every year, okay? But just not growing fast enough to justify the prices that people were paying back here. And that's how you lose this right here. That's how you lose that money. So this might be a little too negative. I mean, because it kind of depends on how many years it takes until they have a rough year. If they go the next 3 years and they keep growing earnings at 25%, it might still trade at a 50 or 60 PE. But we never know when those kind of rough patches are going to come along. And when this mean reversion takes place, it usually doesn't take place over 10 years. It's just kind of how I average it to get a feeling so I can combine these all together. But usually it takes place very fast, and then stock drops like, you know, 30, 40, 50% or something like that, usually in like a year or two. So that's worth keeping in mind. So yeah, I mean, I think long term, unless they really execute everything perfectly, you're probably just a break even on the stock. There's just not a lot of upside. That doesn't mean that this couldn't go to 100 PE in the next year. It could. It just, I mean, but that we can't really predict that. Longer term, we can predict that returns are probably going to be muted for PayPal, and now is a great time to consider taking profits. Everything else looks pretty good. Revenue is awesome. Now the recession PE, that gives you an idea of kind of how much it's run up. So if we went back to where the stock traded kind of during March, you would lose 50%. So, and that can happen. I mean, especially with an expensive stock like this. So that's about it. I mean, it's pretty straightforward. Like I said, the stock is just very expensive right now, and the forward returns are very low, you know, probably 0 or 1% over the long term. Like I said, over the short term, it doesn't mean it couldn't keep going up. If you put a trailing stop on with like 10% and the stock keeps going up, you know, that's a good way to try to capture a little bit more upside. But this one really felt to me like it was kind of a peak exuberation type of a thing after the recent earnings, which were really good. So there we have it. If you would like to subscribe to the channel, don't forget to do that. Like the video. If you found it useful, even if you like PayPal, remember, I'm not saying anything bad about PayPal. I think they're a great company, but the stock is just really expensive. And I'll see you guys next week with some more videos. Thanks.